Hello students, once again welcome back to TG Campus. In the series of issue of shares, we are going to discuss now issue of shares at par concept. Under this concept, we are going to cover accounting entries that we have to pass in case of issue of shares at par. So, you aware about, what is issue of shares at par? When company issues shares at a face value only, so that is known as issue of shares at par. Means if company's face value of one share is 10 rupees and company is issuing that share to the general public at rupees 10 only, then it is known as issue of shares at par. So, whenever company issues shares at par, or whenever company issues shares for a cash and company is issuing shares for a cash at par, there are different types by which company can issue the shares, or there are different ways by which company can issue the shares, right? So, company can issue shares in a lump sum basis. It means company is going to collect money in a single go, or company can issue shares in an installment basis. If company is going with the option of issuing shares in an installment basis, then we have to understand what are the different stages involved, or you can say installments involved. So, there are three stages involved in the process of issue of shares. So, first stage is application stage, then next is allotment stage, and third one is call stage. So, when we are discussing about accounting entries for issue of shares at a par on a cash basis, we have to pass journal entries based on these stages, that is application stage, allotment stage and a call stage. You have to remember, in each and every stage there are two journal entries involved and that we have to pass. So, let us begin with how to develop journal entries, how to remember journal entries while solving the practical question on issue of shares at par on a cash basis. So, first of all, as I said you, first stage is application stage, right? So, in application stage you are going to collect what? You are going to collect application money from the applicants, right, or from the shareholders. So, first entry that we have to pass here is nothing but receipt of a application money. So, bank will going to collect the money. So, we have to debit bank account here. Bank account we have to debit, right? So, we are going to collect the money. So, money comes into your business. So, we have to debit bank account, right? So, which money you are receiving here? As I said, we are discussing application stage. So, you are receiving here application money, right? So, if company is issuing here equity shares, then it is known as equity share application money. If company is issuing preference shares, then it is known as preference share application money, right? So, what you have to do? You have debited bank account. So, bank account debit to, so this money is nothing but application money that you have received. So, you have to credit what? You have to credit equity share or preference share application money account, right? Bank account debit to equity share application money account. You know there is a clause of minimum subscription, right? Unless and until company is not receiving minimum subscription from a general public, company cannot start with the allotment of the shares, right? And that's why whatever money that company received at the time of application stage, that company have to maintain in one separate account called application money account, right? So, company created one account that is known as application money account, and that application money transferred towards, or they have kept there in the application money account. Now, sir, if company is decided to allot the shares, right, then what we have to do? So, that application money is ultimately part of what? So, that application money is ultimately part of your capital only, right? So, for example, if company is going to issue 10 rupee of shares at rupees 10 only. So, this 10 rupees is known as face value and this 10 rupees is known as issue price. So, company is going to collect this 10 rupees from the general public, or you can say from the shareholders, in three stages. So, first stage is known as application stage, second stage is known as allotment stage, and third stage is known as call stage, right? So, for example, at the time of application, company is calling rupees 3 to pay for. Then at the time of allotment, company is calling 5 rupees to pay for. right? So 5 plus 3, 8. So balance 2 rupees. So balance 2 rupees company is going to collect at the time of call stage. Balance 2 is company is going to collect. And now we have to develop accounting entries based on this small example. As I said, first entry I pass for receipt of application money, right? Sir, if one shareholder applied for one share, then company is going to collect what? Company is going to collect this 3 rupees of application money along with that application, right? So we have debited bank account debit to equity share application money account 3 rupees, right? Now, so company is going to transfer that application money towards share capital account, because ultimately this 3 rupees is a part of this 10 rupee only, right? This 10 rupees only. So then that 10 rupees is nothing but the capital of the company, right? So we have to transfer that 3 rupees of application money towards share capital account. So which entry we have to pass for that? So entry is equity share application money account debit to equity share capital account, right? Sir, ultimately that 3 rupees is a part of capital, so I've transferred that money towards capital account. See here, when you collected, at that time you credited application money, and when you are transferring, you have to debit application money account. So debit credit will get cancelled, right? So that application money account will get cancelled automatically, and every money, that 3 rupees that company collected is going to transferred, or we have transferred towards capital account, right? After passing journal entry for receipt of application money and transfer of that application money towards share capital account, another important element is there, and that is nothing but refund of money on the applications which are rejected by the company. So what does it mean? See, for example, application received by companies for 1000 number of shares. Company received application for 1000 number of shares, and as per our example, company is calling 3 rupees along with the applications, right? So in total, company received 3000 rupees as a application money. So out of these 1000 applications, company rejected 100 applications. So if company is rejecting 100 applications, it means company is not going to allot shares to those 100 applicants, right? So it means company have to refund a money, application money, that company received on that 100 shares, and that is nothing but 100 multiplied by 3, it comes to 300 rupees, right? So this 300 rupees of application money company is supposed to refund to those applicants, right? So which journal entry we have to pass for the same? So entry will be equity share application money account debit to bank account, right? This journal entry we have to pass for refund of that application money. So it is nothing but reverse of the journal entry that we pass at the time of receipt of application money, that we pass here at the time of refund of the application money on rejected applicants, right? Okay, so after that, next comes is the allotment. So it means, in as per my example, company allotted 900 shares. If company is allotted here 900 shares, and how much money company is calling? So company is calling 5 rupees to pay for at the time of allotment, right? So now it comes to the allotment stage. In allotment stage also, so we have to pass two journal entries. One is for due of allotment money, and second is for collection of the allotment money. So due is nothing but you are recording that you are going to collect the amount, and that is the allotment money. Or I can say you have to pass journal entry for transferring that allotment money towards share capital account, because ultimately a 5 rupees of allotment money that you are going to collect is a part of capital only, right? So those two entries we have to pass. So for allotment money due, which entry we are going to pass? So which money we are going to collect? So we are going to collect allotment money, and on which share, sir? If we are issuing equity shares, then it is known as equity share allotment account, right? So I'm going to pass a journal entry, and that is nothing but equity share allotment account debit to equity share capital account, right? This entry I need to pass for this 5 rupees of allotment money per share. Okay. After that, so after passing due entry or a transfer entry, I need to pass a journal entry for collection of the allotment money. So what will be the entry? So if you are collecting a money, then you have to debit bank account. So I need to debit bank account. Bank account debit, bank account debit, right? Which money you are receiving, sir? Which money you have collected? So you have collected equity share allotment money. So what we have to do here? We have to credit equity share allotment account, right? If you observe here, when money is due, at that time we debited, and when you collected the money, you credited the same, right? It will get cancelled. So this is the entry that we made for allotment stage. One is for due entry, or you can say for transferring that money towards capital account, and second entry we pass for the collection of the allotment money. Now we have to move further. So next stage will be your call stage. As I said, so 2 rupees is still balance. So these 2 rupees company can collect in different calls. That can be a first and final call, that can be a first call and then final call. It means, I mean to say here, company can collect these 2 rupees in one call only, or company can collect these 2 rupees in 2 different calls, right? And accordingly, I need to pass journal entry. For example, company is going to collect this money of rupees 2 in a one call only, right? So that is nothing but the final call money. So if company is going to collect this money in a final call, then we have to pass again 2 journal entries, right? One for due and another for collection, right? Due entry and collection entry. Now you have to think here, which money you are going to collect? So you are going to collect final call money, right? The money that you are going to collect, you have to debit, right? And that call money is ultimately part of what? So that call money of rupees 2 is ultimately part of your capital only. So you have to transfer that 2 rupees towards capital account. So which entry we have to pass? So entry will be equity share final call account debit, right, to equity share capital account, right? Equity share final call account debit to equity share capital account. Now once you receive that money, so what we have to do? So simply we have to debit bank account, right? So entry will be bank account debit. And which money you have received? So you have received final call money, so you have to credit that, right, to equity share final call account. If you see here, when money is due, at that time you debited, and when you collected the money, you have credited, right? And automatically it will get cancelled, that account will get closed, right? So this is the entry for receipt of call money. So what we did so far, so we covered journal entries that we have to pass when company issues shares for a cash at par, right? After completing accounting entries for issue of shares at par, now we have to see another concept, and that is nothing but concept of full subscription. So what is full subscription? See, suppose if company is planning to issue 10,000 number of shares, company wished to issue how much? 10,000 number of shares, and company received exactly 10,000 applications, or you can say subscription, 10,000 number of subscriptions from the general public as well. So number of shares that company wished to issue is 10,000, and applications received or subscription received by a company from a general public is also 10,000. So it is known as a full subscription. It is a case of full subscription, right? So issue is fully subscribed if the number of shares offered for subscription and the number of shares actually subscribed by the public are same, right? That is the case of full subscription. Now, next concept we have to see is regarding under subscription. So what is under subscription basically? See, it means number of shares offered for subscription is more than the number of shares subscribed by the public. So number of shares offered for subscription by a company is more than the number of shares subscribed by the public. So what does it mean? So it means company is offering 10,000 number of shares to subscribe for, but general public subscribe, or I can say general public shown interest only in 8,000 number of shares of the company, right? So number of shares offered by the company for subscription is 10,000, which is more than the number of shares actually subscribed by the general public. So it is a case of what? So it is a case of under subscription, right? It is a case of under subscription. After under subscription concept, next concept is your over subscription. So what is over subscription? It means the number of shares offered for subscription is less than the number of shares subscribed by the public. So what does it mean? So it means company is willing to issue 10,000 number of shares only, and company is going to issue and allot 10,000 only, not more than that, right? Companies wish to issue and allot 10,000 number of shares, but the general public shown interest for 12,000 number of shares. So it is a case of oversubscription. But sir, even in this scenario, company is going to allot only 10,000 number of shares, that is for sure, right? Because that company is willing to offer only and subscribe only 10,000 number of shares. So what to do about that 2,000 applications that company received extra, right? So what to do about those 2,000 number of applications that company received in excess, that we have to understand here. So if you see a 2,000 applications which are in excess, company is having two options in front of them. Company can reject the excess applications, or company can do pro rata allotment. So what is rejection? So rejection is nothing but company is not going to allot them any single share, right? Company will send them regret later, rejection later, right? So when company is rejecting any applications, your company is supposed to refund application money as well to those persons, right? And what is pro rata allotment? So pro rata allotment is nothing but the money that received by company on this 2,000 number of shares at the time of application, that company is going to use in allotment stage or even in a call stage. So that is known as pro rata allotment. It means company is going to adjust that money, excess application money received by company is going to adjust that money in a further stages of issue of shares. So that is case of oversubscription, right? Yes. So we covered here the concepts regarding issue of shares, which are nothing but accounting entries for issue of shares for cash at par. Then we covered, so what is meaning of under subscription, what is the meaning of full subscription, and what is meaning of over subscription as well, right? Hope you enjoyed this, and stay tuned for the upcoming videos of issue of shares series. Thank you.